Good morning. I'm Darrell West, Vice President of Government Studies and Director of the Center for Technology Innovation at the Brookings Institution, and I would like to welcome you to our forum on financial inclusion. And we are webcasting this event live, so we'd like to welcome our viewers and also those of you who have tuned in via C-SPAN. For those of you who are wishing to post comments during the forum, we have set up a Twitter feed at #FinancialInclusion. That's #FinancialInclusion, so you're welcome to make any comments that you would like. So there are nearly 2 billion adults globally who do not have bank accounts. This makes it very difficult to access financial services, pay bills, or transfer money to relatives. In addition, it is hard in those circumstances to be an entrepreneur when you are outside the formal financial system. It's difficult to gain access to capital or form a business when you lack basic financial services. But the good news is that many nations have made commitments to expanding financial services for the poor. They understand that financial inclusion is vital to economic development and social inclusion. And so as a result, they are developing financial inclusion policies and implementing new frameworks that encourage inclusion. So today, Robin Lewis, John Villasenor, and myself are launching our third annual Brookings Scorecard, measuring progress on financial access and usage. With the support of the Bill and Melinda Gates Foundation, we have embarked on a 3-year study of inclusion in 26 developing countries. The short summary is that we've seen progress on financial services in many places. There are efforts to help marginalized populations, and this is happening through mobile money and digital financial services. As part of our research, we got detailed suggestions from every country. We've also talked with many leaders in the NGO community who are active on financial inclusion, and we're grateful for their support and their help along the way. To give you a more detailed sense of the highlights of our study, my colleague Robin Lewis will summarize the key findings. Robin is a research analyst and associate fellow at Brookings with our Center for Technology Innovation. So with that, I will turn it over to Robin.
Good morning. So thank you to Darrell for those remarks, and our sincere thanks to all of you for joining us this morning, either here at Brookings or via live stream. We are very grateful for your interest in the project, and I'm looking forward to providing a brief overview of our approach and key findings before we turn it over to the panel discussion. So first, I'd like to start with a brief overview of our project. As Darrell mentioned, the Financial and Digital Inclusion Project, or FDIP, was launched in the summer of 2014. The purpose of the project is to provide policymakers, private sector representatives, non-governmental organizations, and the general public with information that can help improve financial inclusion in the FDIP focus countries and around the world. But why does financial inclusion matter? So at the individual level, financial inclusion matters because it provides pathways for people to improve their financial health, which contributes to their overall well-being. Beyond that, it is a key ingredient in advancing sustainable development goals, such as poverty reduction and gender equality. So to support our overall objective, over the past 3 years, we have selected a series of politically, economically, and geographically diverse countries, and we have evaluated their progress toward financial inclusion through a series of annual reports, as well as conversations with diverse groups of experts. So let's talk briefly about the report that we are launching today. This is the third annual FDIP report, and as with the first 2 reports, we examined access to and usage of formal financial services across diverse country contexts. So when I say formal financial services, we primarily focused on basic services, since these are often the entry point to the formal financial system, including savings accounts and government-to-person transfers. For the 2017 report, we have distilled and updated the country profiles that we featured in 2015 and 2016. And in addition to these selected financial inclusion highlights and recent updates, we have included some recommendations regarding key next steps for advancing financial inclusion. Given the scope of our sample and the rapidly evolving nature of the financial inclusion environment around the world, these lists are not exhaustive, but we do believe that they capture an important snapshot of key developments and opportunities for future growth. So, moving to a quick scorecard interview. As Daryl mentioned, one of the components of our report, informed by our research on each country's landscape, is a scorecard tool. To develop the scorecard, we identified 4 dimensions of financial inclusion, including country commitment, mobile capacity, regulatory environment, and the adoption of formal financial services. So in terms of our country sample, we maintain the same list as in the previous year, in which we added 5 new countries to diversify our sample. These countries included the Dominican Republic, Egypt, El Salvador, Haiti, and Vietnam. So we will dive into the dimension-level findings very shortly, but for the moment, here's our preview of the 2017 FDIP scorecard. As you can see, the top-scoring countries are generally distributed across Latin America and sub-Saharan Africa, although countries in other regions, including the Philippines, also demonstrated strong performances as well. So for the 3rd year in a row, Kenya received the top place on our scorecard, in part due to its robust commitment to advancing financial inclusion, as well as widespread adoption of mobile money services. With that said, a number of other top-scoring countries, including several in Latin America, have experienced lower levels of mobile money adoption to date, but often have robust take-up of innovative card-based services, as well as non-traditional access points such as banking correspondence. We think that this finding should be very encouraging to the financial inclusion community because it demonstrates that countries with different political, economic, and geographic environments can effectively pursue different pathways for advancing financial inclusion. So, to provide a better sense of what factors inform these scores, we'll briefly walk through some of the indicators across the 4 dimensions before we explore our findings. For example, country commitment indicators include the existence of comprehensive national financial inclusion strategies, as well as specific financial inclusion protection frameworks, consumer protection frameworks. So these indicators help give us a sense of whether countries are willing to work collaboratively across sectors to make engagement with formal financial services a priority. Moving to mobile capacity, we measured this because it includes indicators related to mobile infrastructure, as well as the number and type of mobile money services that are offered. Now, while digital financial inclusion services extend far beyond mobile money, these offerings can provide a very convenient, affordable platform for those who are typically underserved to access financial services. Moving briefly to regulatory environment, we look at whether regulations, policies, or other guidance concerning electronic money and other forms of digital financial services have been issued. We also look at issues such as mobile money platform interoperability, which basically means whether customers of one service can easily send payments to customers of another mobile money service. Finally, moving to the adoption indicators, we focused on account adoption with both more traditional financial service providers as well as mobile money providers across underserved groups in particular. These groups may include lower income adults as well as women. All the data in this set is from the World Bank's Global FinTech database, and we look forward to updating the data as the new data set is released. Moving to the key findings. So first, let's begin with the country commitment dimension and touch on a few examples of countries' progress. For example, Mexico increased its overall score by 5 percentage points this year to join the top 5 scoring countries. A couple of the changes that prompted this increase include that in June of 2017, the National Council on Financial Inclusion released the National Financial Inclusion Plan. The government of Mexico also joined the United Nations-based Better Than Cash Alliance. Moving to mobile capacity, El Salvador is an example of a country that boosted its score by 5 percentage points over the last year, partly by increasing adoption of smartphones, which can provide a more convenient and accessible way for individuals to access mobile financial services. Moving to regulatory environment, countries from across all of our major regions had strong performances on this component of the scorecard, including Peru, the Philippines, Rwanda, and India, which all received the highest scores possible under the regulatory environment dimension. For example, in addition to promoting mobile money interoperability, India has licensed several entities as payments banks, which effectively is hoped to increase financial access points for underserved individuals. Next, let's move to our adoption findings. The data and metrics on the adoption of traditional and digital financial services are consistent from last year. And so among the new FDIP countries that were added in 2016, one example is the Dominican Republic, which received the highest adoption score among those new countries. Now let's turn to some of the key findings and calls to action in this year's report. So across our FDIP countries, one encouraging finding is that there has been considerable growth in recognition that financial inclusion is not only important for individuals' welfare, but it can also contribute to macroeconomic growth and sustainable development goals, including the ones I mentioned previously. So one interesting data point on this front is that as of this year, all of the countries in our sample are members of financial inclusion-oriented groups or networks. Now, while membership in these groups is important and valuable, we also need concrete steps to emerge from their engagement. So this is where infrastructure investments and the regulatory components of the scorecard come into play. In addition, we also need consistent, detailed data to track progress toward these goals. One example of a portal that enables countries to do that is the Alliance for Financial Inclusion's new data portal, which is a helpful platform, and we hope that more countries will take the opportunity to include timely, detailed data that is available for public consumption in order to help with knowledge sharing and accountability. Moving to our next key finding, FinTech, which is essentially the intersection of finance and technology, provides tremendous opportunities to accelerate progress toward financial inclusion. So basically, FinTech involves the innovative use of technology to both design and deliver financial services and products. And if that sounds like a really broad catch-all term, that's because it is. But this can help enhance the accessibility and the utility of financial services for consumers and render the deployment of these services more cost-effective for providers. So, for example, in a July 2017 report by the Institute of International Finance and the Center for Financial Inclusion, Spanish bank BBVA Bancomer is working with a Chilean fintech to extend credit access to individuals who may not have a typical credit history that they have established. We're excited about these kinds of developments because they not only enable customers to access financial services, but they can also help it become more accessible for individuals to use these services and intuitive. So how are some countries taking FinTech into account? One example is in Indonesia, where as of August 2016, the Financial Services Authority provided an outline of guidelines for the local FinTech industry. Additionally, in South Africa, FinTech is increasingly prevalent, and a FinTech regulatory framework is expected to form part of the Conduct of Financial Institutions Bill in 2017. Finally, we encourage countries to amplify investments in cybersecurity efforts and knowledge sharing in order to fully reap the benefits of financial services innovation. So with the proliferation of digital technologies, boundaries are blurring across traditional financial service providers and as well as tech startups and other groups. So while many of these fintech companies are very nimble and cost-effective, they may also not have the resources, the infrastructure, or the experience to ensure that the services that they help provide are safe and secure. With that said, of course, banks are also not exempt from this, particularly when they have outdated or centralized systems. So in a conversation with many stakeholders that we had in February of this year, one suggestion that emerged was from policymakers as well as financial service providers to work with technical experts to essentially provide a set of menu options to enhance cybersecurity and provide technical assistance for implementing those solutions. So moving forward, we look forward to hearing from all of you regarding this year's report and scorecard, as well as the 2015 and 2016 reports. And we will continue our efforts to facilitate dialogue regarding important financial inclusion developments and the outcomes of the scorecard. We have an address set up here, FDIP Comments at brookings.edu, where we welcome your feedback. And now, thank you for listening to the presentation. And I would like to invite our moderator, John Villasenor, as well as our distinguished panelists to the stage to share their perspectives on financial inclusion.